Hello and welcome to our end of March update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. And this is April the 1st, which means quarterly update. Bet you thought I was going to say April Fool's Day, didn't you? Well, with taxes coming due, I wish I could laugh. But at least I can give you a long-anticipated update. Speaking of updates, I know many of you are eagerly anticipating my book, and I know I've said by the end of March. As a first-time author, I didn't realize just how many steps there are in publishing. So far, the rough draft was done, the line edit was done, the copy edit was done, where an editor with a fresh pair of eyes went through to make stylistic and consistency changes, and now the book is with a professional typesetter and interior designers. I've been told that this is the last step. After this, they'll send me a hard copy proof, and if I approve it, the book launches. Meanwhile, these past few months, this year, I've been embellishing and clarifying the major systems I've been describing in the book. I've essentially given away the meat of my book with these last few videos, but I don't care. The whole intent of this book and these update videos is to spread the word. Spread hope that reasonable, effective investing is available to peon investors like ourselves. Help mitigate any fears you may have about investing enough to start taking action. Remember, I described 4 separate systems. Don't mix them up. Those are the 20-month Simple Moving Average, or SMA system, the Monthly Rotation Investment System, or MRI, and I usually gloss over the Trailing Stop system and the Dollar Cost Averaging systems, only because they're basic concepts, but useful to keep in mind at least every month. Remember that these last 2 systems will give you variable results, depending on your choice of stocks you use for your trailing stop system, for instance, and how often you contribute to a dollar cost averaging system. So let's just jump right into our first system, the 20-month moving average system. As you can see from the graph, the S&P 500 index, represented here by the VFINX, which is the Vanguard S&P 500 index fund, is safely above our red line, the 20-month moving average. Remember, the 20-month moving average is just the average monthly closing price of the last 20 months, adjusted for dividends. When the VFINX is above the magic red line, it's relatively safe to be in stocks, specifically S&P 500 index fund, and whenever the VFINX ever falls so much that it ends up below the 20-month moving average, that's a sign to get out. So let's put some numbers on this. The VFINX on this last day of the month is $190.71 per share. The 20-month moving average is $174.50. So do the math. 190.71 over 174.50 gives us a 9.3% cushion. In other words, stocks go up and stocks go down. Who knows what direction they will go tomorrow, next week, or next month? But unless the index drops more than 9.3% by next month, the general trend is roughly up. If you're thinking that this type of investing is kind of like a trailing stop, you'd be right. The concept is the same. As the index rises, the average also rises, locking in gains. We just take this concept to a higher level by substituting a bond fund for cash when we sell stocks when the index dips below the moving average. So here's how we're doing so far with this system. This black line is the S&P 500 index fund if you just bought, held, and prayed, and reinvested dividends. And this green line is what happens when we switch into the VUSTX bond fund whenever the index fund fell below this magic red line. Now, you're going to see a couple of differences between how I am presenting this data now and how I used to present it. Notice here how between 1996 and 2000, how the green line is underperforming the black line. How can this be? Well, this is what happens when you ask a guy like me to do this for you. We have to correct for management fees. Yes, I produce these videos as educational videos. I teach you what I do as an investor. I share with you, doctor to doctor, investor to investor, how I invest. Some people get it. Some people need a little extra hand-holding in the form of monthly updates. Some people need more close coaching and supervision. And then there are those who would just rather have me invest for them. And herein lies the conflict. As a registered investment advisor, even though I produce these update videos from a place of education, auditors can twist and see anything I produce as potential sources of advertisement. So, if I'm advertising, I must correct for management fees, which is what you're seeing here. This is probably a good thing because you can see that at least the back-tested model works, and you can do a bit better by yourself by doing this yourself. So how well is the 20-month moving average system working so far? Well, if you took $10,000 in May of 1986, back when $10,000 was actually worth something, and you invest in just the index fund and reinvested all the dividends, you might have $139,000 and change, or 1,295% return, or 9.5% annualized return. However, if you were wise enough or clairvoyant enough to start using this 20-month moving average way back in 1986 when the bond fund just started, you might get $233,000 and change, or 2,236% return, or 11.3% annualized return. And impressive as it looks, forget total returns. The real strength is that even though stocks go up and stocks go down, the big bear markets, like here and here, the big bear markets is what kills our returns. We're not seeking to eliminate all losses. We'll take the smaller ones, but at least we have a mechanism to detect when the markets are in danger of losing a big chunk. And right now the system is telling us that if the S&P 500 drops more than 9.3% by next month, get out of stocks. And now for something completely different. The MRI, the monthly rotation investment system, where in our particular flavor we rotate between the S&P 500 index fund, the emerging markets fund, and the inverse S&P 500 index fund. We updated numbers. Used to be February numbers were here, now we shifted over here, we put the March numbers in here, we cut the new ratios, and voila, we have a new winner this month. That is the inverse fund. And here's a graphical representation of what's been going on the last month between these three different funds. So for our current model, at least last month, we were 3/4 in the S&P 500 index fund and 1/4 in the inverse fund. This month, we're supposed to sell 1/4 of our S&P 500 index fund and buy the inverse fund. So you see how now we're roughly 50-50 inverse and index fund. And for some of you astute members of our audience, one inverse fund roughly cancels out one index fund. So a portfolio made up of 50-50 index and inverse is roughly equivalent to a portfolio that's holding just cash. If you were to just sell into cash, you'd be saving on commissions in the future. So again, here's our system with backtesting. If we plotted the purple line, which is the MRI system, against its constituent funds, here's the VFI index, the index fund, the emerging markets fund, and the inverse fund. By dynamically rotating into the dominant fund each month, it is possible to beat the best performing fund over time. Again, I factor in fees to show how robust the system is. Robust provided that you follow the formula like clockwork each and every month. So over the last 21 years that the VEIEX has been in existence, the MRI system with these three funds might have returned $112,000 in change from an investment of $10,000, or 12.25% annualized after fees, compared to buy, holding, and praying the S&P 500 index fund, you'd get 9.44% annualized. You can see how just a small change in annualized returns can make a large difference in your account over time. And again, just remind those of you who dollar cost average to keep at it. There's just one rule. Keep buying equal dollar amounts of whatever it is you're buying, whether it's just one mutual fund or a more sophisticated system of investing. Just keep buying equal dollar amounts at set periods of time. That's it. If you do automatic withdrawals either from your paycheck or from your checking account, great, you're on autopilot. Otherwise, stay consciously aware of what you're doing and don't skip any time periods, no matter what the news tells you about what the markets might be doing. And of course, the trailing stop method. Just a few simple steps. Keep positions small so that idiosyncratic risks of individual stocks do not threaten more than 1% of your portfolio or trading account. We do not need Vegas in our investing. If the stock really does shoot to the moon, you'll keep a bigger and bigger block of shares. Check at the very least once a month to see if any positions have stopped out, and to see if you need to add any other positions. Make no mistake, even with wide 25% trailing stops, you are trading and thus must keep your eyes open. And until next month, invest safely.